Alibaba is finally reporting earnings on May 26th. Here is what we're expecting, or what the analysts are expecting for the years coming up. For this year, they're expected to make $7.57 per share for the entire year, which is a 25% drop from last year. For this upcoming earnings, they're expected to make about $2.50 per share. Now, the way analysts work is they make a lot of assumptions, probably 40 analysts on this, and they're modifying it up until the day of earnings because they want to be reasonably close to what's happened. Alibaba has fallen from $310 or $320 a share down to as low as $70 or $75 per share. And I think now it's hovering around $92, $93 per share. So a big drop. One of the big reasons is because people for a while were worried that Alibaba was going to get delisted from the US exchanges. I personally called Merrill Lynch and Mo called Charles Schwab to ask them what would happen if this actually did occur. And their comment was, if you own shares in Alibaba through our firm, you get the shares in Hong Kong and you can do whatever you want with them. The only issue might be getting the money back quickly. It might take a few weeks to get the money from Hong Kong to the US if you decide to sell the shares. So this was my belief that people were over-exaggerating. At the end of the day, what I look at is 10 years from now, do I think Alibaba will have higher revenue than it does today? The answer is yes. Do I think Alibaba will have more profit than it does today? The answer is also yes. It is a huge company, worldwide company, the Amazon of China. It has got movie studios. It's got so many conglomerates underneath it that I love that. They just increased their buyback from $15 billion of shares to $25 billion. They have a lot of cash. They're generating a lot of cash. Is there short-term issues? Are there short-term issues? Absolutely. No company that's selling cheap relative to a higher price before doesn't have some sort of issue. The question you have to ask yourself is, do you perceive the issue to be relevant to today or not? Is it an over-exaggeration of what might happen? That is what we're trying to teach. There's a process. I don't know. In our community of over 6,000 people, there are people that believe Alibaba is a great buy, and there are people who don't believe it is a great buy. Charlie Munger recently sold half of his shares of Alibaba that he owned. Why? Why not the full amount? I have no idea. In his 13F, that's all we see is that he sold half of his holding. Recently, Ray Dalio bought a lot of Alibaba. Does that mean it's a good buy? I don't know. Ray Dalio is a well-known and good investor, but people get it wrong all the time. We don't know the exact reasons why they make these decisions. My thesis on China is that it's here to stay. It will probably be the largest economy in the world relatively soon, and the middle class, the fastest growing middle class in the world. So Alibaba will likely grow with it. But more importantly, are you paying a reasonable price for Alibaba? So let's go through our 8-pillar process on Alibaba to see where it's at. All right, guys, this is our 8-pillar software. As you know, we're going to go to the 8 pillars tab. We're going to type in Baba. Go right to it. Okay, so guys, this stock is selling for below where it was back in July of 2017. So it's fallen pretty hard. Now, again, guys, was Alibaba a great buy here just because it's going up? And is it a sell just because it's going down? No. In the long run, stocks are a weighing machine. In the short run, they're a voting machine. And in this stretch, the vote was buy, buy, buy. In this stretch, it was sell, sell, sell. Okay? So, first things first. Market cap of Alibaba, $243 billion. Our first pillar is we want a 5-year PE under 22.5. The 5-year PE is 15 right now. That's a check mark there. Pillar number 2, we want the 5-year return on invested capital being greater than 9%. Right here in our software, it's 11%, right there on the main page. Now, Alibaba does not pay a dividend, but look at their free cash flow. 5-year average was around $20 billion. Last year was $25 billion. So really high free cash flow and growing based on that. Pillar number 3, we want revenue growth over the last 5 years. So we go to the income statement on our software and we do our 4 quarters as it states right there. Actually annual for Alibaba. And it was $23 billion 5 years ago, $106 billion as of late. Okay. Now, in the last 4 quarters, look at it. $124 billion. The previous one was the full fiscal year. Guys, this company is growing like crazy. Pillar number 4, we want net income growth over the last 5 years. Scroll down. Net income 5 years ago was 9.9, call it $10 billion. And it was also $10 billion here. So immediate red flag. Whoa, whoa, whoa. Why is the profit dropping from 23.6 down to 9.8? Well, one of the things we can do is we can scroll up here and see other income and expenses, 2.1 billion, and special income and charges, 3.73 billion. Immediately right there, we see $5.8 billion of expenses that look like one-time charges. Understand what those are. Go to the 10K, which you can get on our main page by going to the metrics and scrolling down to the bottom, the annual reports. But that's something to understand. Remember, the 8 pillars tell a story that we need to understand. If you just looked at $10 billion in profit fell from 24, you'd be like, oh my God, this is terrible. But I immediately said, well, wait a second, there must be something here. That's why I did that. Pillar number 5, we want shares outstanding to be the same or lower. So we scroll all the way to the bottom of our income statement. We go to the very bottom. 5 years, at the end of 5 years, beginning of 5 years, 2.49 billion, 2.69. So they have more shares outstanding, but they are buying back shares. And I like the fact they're buying back shares because the stock is relatively cheap compared to the past. All right. Pillar number 6. This is an important one. It has to do with debt. We want to be able to determine, is the company's debt level reasonable? So what we've decided to do was we take the 5-year average free cash flow, we multiply it by 5, and we want the long-term liabilities of the company to be under that. So we go back to the main page. If you remember, on the main page, we have all of our major information. 5-year free cash flow is 19.8 billion. Let's call it 20 billion. Multiply it by 5, that's $100 billion. So we want their long-term liabilities to be under $100 billion. So how do we find that? Very simple. On our software, you go to the balance sheet, you go to the most recent quarter, scroll all the way to the bottom, $35.7 billion. Guys, we want it to be under 100. This is incredible. They can pay off all of their long-term liabilities with under 2 years of free cash flow. That is incredible. Pillar number 7 and 8 have to do with free cash flow. So pillar number 7 is we want free cash flow growth. So we go to the cash flow statement on our software. Now, with foreign companies, we have to do annual here for the cash flow statement. 5 years ago, they did 9.69. Last year, 28 billion. Check mark there. So guys, look. Here we added this line in our software. No other financial statements will show you this line right here. But we realize how important it is. 9.7, 14, 15, 20, 28 billion. And remember, guys, they had a big drop in their earnings in the last year, but they had a high free cash flow. They were write-offs. Make sure they're one-time write-offs. That's super important. And our final metric, guys, we want to take the 5-year average free cash flow, 17.4 billion, multiply it by 22.5. So very simply, we pull up a calculator, 17.4 times 22.5. We want the market cap of the company to be under $391 billion. Remember what the market cap was on the main page? It was $243 billion. That is a massive check mark. Guys, that was a lot of math. Let's go to the 8 pillars tab. It shows you everything here. The net income growth and the shares outstanding are the only X's we have. They already solved this problem by telling people we're going to buy back more shares, and the net income was because of write-offs. So if you take those out, which is still important, but there's a good story behind those. The next question you have to ask yourself is, what are you going to pay for the stock? And that's why we have the stock analyzer tool. Every investment's the present value of all future cash flow. So this allows us to make assumptions about the future. So let's go to the stock analyzer tool. Now, first off, guys, it's a growing company, but my goal is to be conservative. My goal is to pick lower numbers and buy when the company is selling for those low prices. There are 10,000 stocks out there. Find the 20 to 40 that make the most sense. So even though their history has major revenue growth, I'm going to go much lower. 6, 9, 12% revenue growth. Profit margin. Now with profit margin, guys, remember, it was affected by those write-offs. So I'm going to focus more on this 5-year number. I'm going to do 18, 20, and 22. Free cash flow. Actually, guys, I'm going to do the exact same thing. Now, PE. I'm going to do 13, 15, and 17, and same with the free cash flow. And then for my final desired return, I always do 12.5%. Why is that? 12, you can get 9 or 10% by investing in an ETF. So if I do 12.5%, it gives me ample margin of safety for a company of this size. And it also gives me a reason to go invest in an individual company. Why go spend Why go do all the work to just get 9 or 10% I can get in an ETF? I hit the analyze button. We're checks all around, guys. 119, 177 is the middle, and 262 is the top number. It's currently selling for $89.97. Does this mean go out there and buy it? No. It means that this is a company you should do more research about. If you're part of our community, start talking to people about what they see in Alibaba. What are the pros? What are the cons?